Hi, Dan.
Hey Chelsea, how you doing?
Good. How are you?
I'm doing great, thanks.
Ready to talk about some forbearances and let everyone know what's happening out there?
Absolutely. So I'm Dan Ancheta. I'm a branch manager at Synergy One Lending in Petaluma, and happy to chat with you all about mortgage forbearance.
So there's like a lot of back and forth on what a forbearance is and what everyone seems to think is happening or not happening and what you need to pay or not pay. So first, what is a forbearance for anyone who might have a mortgage?
Sure. So forbearance is an agreement between the lender and the borrower that the borrower does not have a payment currently due, um, and that they have a requirement to repay the debt at a later time. So we see this a lot in student loans where you might have a doctor that goes through medical school and their loan, they'll accrue debt through that time period, and their loan will be in forbearance, which means that they don't have a current payment due while they're in school. And when they get a job and start the residency and they start making money, then that is when they start repaying their loans that take them out of forbearance, and they start having an active loan that they pay on a monthly basis. And so what we're doing now in the mortgage world is, because of the CARES Act, which is the response to the coronavirus, uh, Congress has passed the bill that says that if your loan is owned by Fannie Mae or Freddie Mac, that you do not have to pay your loan if you've been impacted by COVID-19 for 360 days. No payment is required. And that is something you need to arrange with your loan servicer if your loan is owned by Fannie Mae or Freddie Mac, which are the government sponsored entities, um, and have been propped up by the government since the meltdown in 2008.
So how do you know if Fannie Mae or Freddie Mac owns your loan?
You can look it up online. There's a tool. I was just doing it on my house, and you can just Google, does Fannie Mae own my loan, or does Freddie Mac own my loan? And um, there are websites that they've established that you put in your name and your address and the last four digits of your social, and it will tell you if your loan is serviced by either of the GSEs. So very simple to do. And I think that website predates COVID-19 because anytime that there's a natural disaster, we look to the agencies to support homeowners. So during the wildfires here, during a tornado, a hurricane, floods, any of those type of things, you need to know who owns or services your loan. And the vast majority of loans, maybe not vast, the majority of loans in this country are serviced by or owned by Fannie Mae, Freddie Mac, but not all loans are. So if you have specialty financing, if you have a jumbo loan, if you have a loan through a credit union, there's a lot of other avenues that you can go through. Those loans will most likely not be owned by Fannie Mae and Freddie Mac. And then the CARES Act legislation does not apply to you. And you will need to call your loan servicer if you need help with your loan to work out a forbearance or forgiveness or delayed payment or changing in your payments terms directly with that lender, because they are not required to forbear your loan like Fannie Mae and Freddie Mac are.
Interesting. Okay. Um, so so you don't know right away who owns your loan, so you can just go to Google, go to this website, and type in this information, and then it's pretty simple to figure out who owns your loan and how to go from there.
Yeah, so I would search, if you go to Fannie Mae's lookup tool, it's not there, go to Freddie Mac, it's not there, then your loan's probably not owned by either of them. Call your servicer at that point, whoever's the name on your mortgage statement that comes in monthly. Call them and say, hey, I need some help here. Here's what's going on. If you need to forbearance. So I think it's a good moment for me to interject and say, if you can make your payment, please make your payment. If you can, please do it. The lasting impacts of this is that if we have people who do not need forbearance that utilize it, um, can really hurt the mortgage industry and therefore the real estate industry. And will wind up having long-lasting impacts on the way that we qualify people to get credit, the housing prices and values. So if you can, please, 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 please make your mortgage payments if you can. Was that enough pleases?
That's enough pleases, I think.
Okay, good.
So
If you
how do
can't,
you
if you
know?
can't, that's okay. If you can't, then coordinate with your servicer to find a solution. So I think there's kind of three major solutions that were being used right now. One is a deferment of payment and lump sum. You skip 6 months of payments. At the end of 6 months, you pay all 6 months back. That was not ideal. The lump sum solution is not great. Most households don't have 6 months of their mortgage payment saved up, and going into retirement, funds that have maybe been blasted in the stock market, which bouncing back, so that probably should be fine. But anyway, it's not a great solution to do that. The second option that I've seen is reducing your monthly payment now for 12 months and then increasing it for the following 12 months. A quick example, my mortgage payment is $2,000 a month. For the next 12 months, I talk to my servicer and I'm going to pay $1,000 a month. And after 12 months, my payment goes to $3,000 a month. And I pay that for 12 months. So at the end of 24 months, I've still paid the same amount as I would, just in a lesser amount for the first 12 months, and a higher amount for the second 12 months. Everyone is happy and moves on with life. And the third option, which the FHFA, Federal Housing Finance Authority, I think that's the acronym, which is the government agency that oversees Fannie Mae and Freddie Mac and creates their rules, says that mortgage servicers will be required to allow payments missed to be added on to the back of a loan so that no lump sum will be required. And the head of that agency, I'm going to pull it up, so sorry for looking away from the screen, guy named Mark Calabria, he says, during this national health emergency, no one should be worried about losing their home. No lump sum is required at the end of a borrower's forbearance plan for enterprise-backed mortgages. He's talking about Fannie Mae and Freddie Mac there. To help homeowners navigate the forbearance process, the FHFA partnered with the CFPB on the Borrower Protection Program to provide homeowners with accurate information. Okay. So basically he's saying that no lump sum will be required. So how that's going to work out, what the alternative is probably to add payments on to the end, but there may be another option that we haven't discovered quite yet. There will be something to resolve this issue. So if you need forbearance, talk to your servicer.
Okay, so you have a Fannie Mae or Freddie Mac loan. Yep. You can forbear your payments. How do you know if you qualify to get a forbearance, or are there requirements that you have to meet to get the forbearance?
There aren't requirements. All you have to do is say that you've been impacted by COVID-19. There's no documentation needed. So I think in a way this is good and in a way it's bad. I think that there should be some burden of proof to show that you've been impacted so people don't take advantage of the forbearance system. But at the same time, if there was a requirement to do so, it would really slow down the process of getting these things approved. And the most important thing is that we have people who can afford to eat and to survive this. And so, what is the most important thing is the health and livelihood of our people, of our citizens. So I think that in an ideal world, we would have had some tests to show that you actually needed the forbearance, but the practical application of that would have made this such a slow process that people who really needed help today wouldn't have received the help for months. And that's a worse solution than someone taking advantage of the system, right? It is what it is. There's going to be those people, and we can't stop that 100%. So is what it is. But yeah, no proof required. You don't have to come with any documentation. You just say, this impacted me. Check a box.
Wow. So nobody's going to show up to your office door making sure that you're not at work, but still can't make your payments.
Yeah, and you could still be working and still need forbearance. Like I said, it's not just if you got laid off or if you're on unemployment. You might have hours cut. You might have increased expenses. You might have, I don't know. There's 1,000 solutions or situations I could think of that would make it so you were impacted greatly by COVID, and you need forbearance. And I think that's an okay thing. Um, so yeah, I think it's not a perfect solution to have everyone, not everyone, but have forbearance so loosely granted, but it's going to help more people than the number of people who take advantage of the system.
Right. So how about like long-term effects on your overall credit score maybe, or how will a forbearance reflect on you as later down the road when you want to get another loan for maybe an investment property? How will that forbearance affect you now and then?
So it won't impact your FICO score, and this is what they say. So I think that they have to obviously change the algorithms that the credit bureaus use to derive our scores. What I've seen is when I pull someone's credit, it'll tell me if they're in forbearance or not. It will say on the mortgage record, current, in forbearance or forbearance, whatever the term is. And that precludes me from closing a loan until that loan is current. So what that means is that before you can refinance, before you can buy that investment property, before you can sell and buy something else, you need to resolve your forbearance status with your lender, and for that to be reflective on your credit report so that we can move forward with a subsequent transaction. So in theory, this won't impact your FICO score and your ability to qualify in that regard, but you need to have current loans and able to close a new transaction. So our systems have changed where we are verifying that payments have been made. We did that anyway, but we're doing that kind of at the last minute to make sure if I'm closing a loan in May, that April's payment has posted and that they have not subsequently requested forbearance. And if it doesn't come up on the credit report that they're in forbearance, and I find out before we close that they requested forbearance for whatever reason before we can close the new loan, then we can't do that loan until they're out of forbearance. So the due diligence that we're doing is, and that's kind of across the board, not just in the forbearance world, but for employment, for other types of accounts that we're looking at for assets. We're looking a lot more closely on qualifying our borrowers to make sure that they can make these payments, and that when we create a loan and sell it for servicing, that servicer is buying a performing loan to our best knowledge, that they're going to get a buyer or a borrower who is able to make the payments and has current employment, assets, income, the whole thing, when the day that we make the loan. So we're calling the morning of that we fund a loan to verify employment, to make sure that someone's employment status is still current and that their employment income has not dramatically changed. Because I'm talking to friends and clients, and we're seeing things like, hey, our company wants to be here at the end of this, and so we all are, and every employee is taking a 30% pay cut. Well, if that 30% pay cut makes it so your current income is not enough to qualify, we can't do the transaction in that structure. We have to find another way to do that. So we're being very mindful that there's a changing landscape, and we want to do the right thing for the clients and the right thing for our investors. And that's what I do all day, is talk to people and have those tough conversations about what's happening, and making sure that we're all clear on if there's big changes in your employment, or you're concerned about it, that we're having open discussions. And that's saving my realtor partners a lot of time and making sure that their buyers are fully ready to go and make those purchases. So yeah, that's what a little rabbit hole. Here we are.
So it won't affect the overall score, but will it show as a derogatory mark on your credit
not derogatory
later?
It's not derogatory. It's just something that we need to resolve. It's a question that we'll ask. I think that we'll see a lot of it in the future, a lot of records that will have been updated, and we'll have to get documentation from the borrower that shows that they're out of forbearance and that they're making payments and they're current, and they have a plan to either add those payments to the end of the payment, to end of their term, or make a lump sum, or whatever the combination of that is. so that we can make a new loan. I think it's important to kind of step in here and say that in turmoil times like this, fraudsters are everywhere. There's fraud happening everywhere all the time. People making calls, taking advantage of people's goodwill, and I just despise those people. I hope they step on a Lego or something terrible like that. But listen, if you are concerned about, if you get a weird phone call from someone you don't know, it's always okay to end that call and then call back your loan servicer. If you're getting calls from third-party people offering you help to fix things and do this and do that, most likely it's fraud and they're trying to take advantage of you either by getting your data, stealing your social security number, or just going to try to charge you money to do this for you. This doesn't cost anything. Call your loan servicer. If you have a problem, call me, call another qualified mortgage professional in your community. We're all here to help. There's great people in our profession. So reach out, call up your realtor, call someone. But please don't be a victim in this time. Don't, that would make this even worse. That would be the, what could be worse than this? Well, losing a bunch of money to fraud would be worse than this. So anyway.
And you hear like horror stories of people going to the banks and withdrawing money because someone called and said to send $30,000 to protect themselves. It's the worst.
Makes me sick. Makes me like,
worst.
Yeah. Yep.
Okay. So you had mentioned that please pay your mortgage payment if you can, because it'll affect the mortgage industry and real estate industry negatively if everyone is just getting forbearances. How does it negatively affect those industries, primarily the mortgage industry?
So let's take an example of what they call a first payment default, which means I make you a loan today, and before your first payment is due, you unfortunately lose your job or whatever the situation is, and you go into forbearance before you actually make your first payment. Fannie Mae and Freddie Mac will buy those loans, but the guidance that they've given the lenders is that loan is going to cost it's going to cost the lender 500 to 700 basis points, so 5 to 7% of the loan amount for Fannie Mae and Freddie Mac to buy that loan from the lender. Lenders on the back end, at the end of the day, make about 50 to 75 basis points total, depending on their business model, on a loan. So it takes 5 to 12 of good loans profit to make up for that one loan that goes bad. So if you go into forbearance, you may wind up costing the mortgage company the profit of 12 loans, 10 to 12 loans in profit to make up for your one loan that the agency will technically still buy, but at a huge cost. What that does then is it causes the mortgage companies to increase their rates on all those other loans to make up for the one loan that goes bad, because they still have operational costs, they still have to pay their people, they have shareholders that they need to pay dividends to, all these other things. And so what we wind up with is higher interest rates in an environment where we should be seeing very low interest rates, and which is beneficial to consumers, beneficial to home values, beneficial to investors, beneficial to renters, across the board, beneficial. And will also spur the economy on. Cheap money, spurs the economy forward, which we're going to need when all this is done, is the economy to have some adrenaline pumped into it. So that's all good stuff, and we can lose our some of the high octane fuel that we're going to need if we're bogged down by a bunch of unnecessary forbearance situations that are going to wind up costing higher interest rates across the board. I don't want to see that. I want to see everyone take advantage of these once in a lifetime low interest rates to secure long-term financing for their dream home, that house they're going to raise their family in. That's why we do what we do. So, let's all, if you can, like I said, please make your payment. There's a lot of unintended consequences here, because that servicer still has to pay their employees, the ones that are taking your phone calls. Those people seem to get paid. So if we're not making our payments, there's not enough income for those servicers to pay their people and keep paying the coupon rates and the investors that they have to pay in a mortgage-backed security world.
So I actually heard a suggestion somebody made to me the other day about paying mortgage payments. They suggested using your credit cards to pay your mortgage payments so you don't have to do a forbearance. Is that advisable or no?
I think that that is not a great idea. I
No?
think that I think that with this new guidance from the FHFA saying that you can add the payments on to the end, I would not recommend someone get into a bunch of unsecured high interest credit card debt kind of ever. I think that if you're in that situation, so I used to take a step back and say, this isn't time that we learn a lesson about having an emergency fund. And I will refer to someone who's been speaking this loudly on his bullhorn for many years, Dave Ramsey. Dave, if you're watching this, you're not, but if you are, uh, we're listening. Everyone should have a 6-month emergency fund of all your bills. That is not realistic. I get in a lot of times, but it's something to aspire to. Get small, save your money, and have an emergency fund. So if this happens again in the future, which you probably will, that you don't have to make that really tough choice. That you have some cash stowed away to make it through a recession or being able to give you the time to figure out a solution instead of month one you're paycheck to paycheck, you got nothing, and then you're waiting for a $1,200 check to come in the mail. That doesn't sound like an ideal situation. So yeah, so credit card, don't do that. That's not I would no, please don't do that.
Don't rack up the credit card debt.
No,
Take
that's
forbearance.
ever like not, yeah, no, not especially if you can add this payment onto the end. Don't do that because the credit card company's not going to let you do that. And then what we wind up with is a bunch of people who have a lot of unsecured credit card debt and they're all filing bankruptcy, which is not a good. Don't do that. No.
So is there anything you think maybe I missed that mortgage holders or potential buyers should know about what's happening right now in the mortgage industry and with forbearances, and what we think, can make potential buyers as strong as possible to get a loan so they can take advantage of those low interest rates?
Yeah, so I think the silver
Anything?
lining here is what I've seen in my world, and I don't know if this is every other lender or real estate person out there, but what I'm seeing is that the clients of mine who have been looking for a while, they are maybe lower down payment, 3% down, 5% down, 10% down. First-time home buyers are, and even I have a few VA clients that are doing 100% financing. We're getting them into contract because there's not a ton of buyers out there right now in the middle of this that are going and looking at houses. It's not on their priority list. So if you're primed up and you're ready to go and you can make that offer, I see people that have been getting beat out. 10 offers on houses are one of 2 offers, and we're having a lot of success getting them into contract. So for those buyers, I say, go for it. Now might be the time. Have that conversation with your real estate professional and your lender, and I think that's good. I think that the other part of this is that there's still huge demand for housing, especially in the North Bay, California, where we are. When this is done, the real estate market's going to be fine, in my opinion. I think that the fundamentals behind this are going to be okay. We're going to see shifts. We're going to see lots of different changes. One thing I've been thinking about is how many people want to continue to live in large metropolitan areas, and especially with the likelihood that telecommuting will be more of an option. This is going to be the new normal, that people are going to be able to work from home and work remotely. That someone who's working or living in San Francisco maybe goes, yeah, you know what, Sonoma, it's close enough where I can go into the city, but I've been working from home for 60, 90 days and I was just fine. I don't want to live in the city anymore. I want to move to Sonoma or Petaluma or Santa Rosa, whatever it is. And they can still have that high wage earning job in San Francisco, but work remotely and maybe go into the office once a month for a team hoorah meeting or whatever they're doing now, if that's even allowed. And I think that's going to provide a lot of opportunity for the real estate market to have new entrants into the market that will come in and keep buying up all the awesome real estate we have here.
Awesome. My last thought on this is I keep seeing everyone on Facebook and social media saying like, don't buy now, like wait for the real estate industry to crash. You're going to get a great 5-bedroom.
Oh, you clicked out, but I think I can answer the question. Um,
Protect from having this massive real estate crash because people aren't going to have to be foreclosing on houses and not being able to make their payments anymore.
right. No one wants to see 2008 again. And I think the lessons that we learned in that recession that was driven by the credit markets and by an overinflated housing market, amongst other things, but those are some of the primary drivers. I think that the Fed knows that swift action is going to be needed and necessary to keep that from happening again. And they've done a pretty good job at taking care of the short-term shortages that we would have had without them to shore up the markets so that we don't see that again. I think that's on the forefront of every lawmaker, legislator, civil worker, everyone who works in this industry, the professionals there. They don't want 2008 to happen again because it was tragic. It was awful. People lost generational wealth. Hardworking people lost their homes. Nobody wants that. So, will there be a downturn in prices and values? Maybe short term until the new normal sets in. But the reality is that there's a housing shortage. We're not building up houses. Our population is growing, and we will need more housing. Um, well, there's a shortage of housing, which is going to drive up prices, especially in desirable places to live, like beautiful Sonoma County, California, where you and I both are. So I think that in 6 months, maybe you see a 5% decrease in values, but 6 months after that, we're back on the trajectory that we were with, 2-3% year over year appreciation, maybe more, maybe in that range. I don't foresee that being, could be wrong. We'll watch this video in 5 years and go, Dan, you were so wrong. But from the mechanics that I see and the cheap money that's out there, I don't see that being a real feasible option in the long term.
I agree with you. I don't see it happening. I think we learned a lot from 2008 and we're going to do whatever can be done to not have a repeat of that happen.
Right. I think you're right. So yeah, so
Awesome.
people out there, if you're, need some help with anything to do with real estate or finance, I'm totally happy to Zoom call and chat with people. And even if you're using another lender and you wind up using someone else, I totally get that. It's fine. I just want to be a resource to people out there, answer questions, and make sure they're getting good information. So that's where I'm at.
Thank you. So final takeaway, make those mortgage payments if you can. Otherwise, talk to your servicer about your forbearance options.
That is the summation of everything. I think is that's it. And be well, wear your masks, wash your hands.
Awesome. Thank you, Dan.
Thanks, Chelsea. See you soon.
Bye.